Selling these 6 assets before you retire could mean the difference between running out of money in your 80s or having the freedom to spend confidently for the rest of your life. So in this video, I'll show you the 6 assets you must sell before retiring, and the simple test you can use to decide whether an asset protects your retirement or puts it at risk. The first asset is one that can turn a bad year at the wrong time into the reason your money doesn't last. This shows 2 retirees who both start with $1 million. They both experience the same drop. The only difference is when that drop happens. Retiree 1 gets that drop in the first 2 years, and because they're taking withdrawals during the decline, it drains the portfolio, and they end up running out of money. But retiree 2 doesn't get that drop until much later, and that early head start means their money lasts years longer, even though the drop is the same. So the risk isn't just a drop. It's a drop early on, right when you need to take out your money. And there's one asset that can make a drop at the wrong time nearly 4 times as risky. This shows the 20th percentile calendar year return for the S&P 500. So in a bad year, but not a once-in-a-lifetime crash, the S&P might be down about 7%. And in order to recover those losses, you'd need about an 8% return. But instead of looking at the entire index, this next line shows the same year, but if you're invested in a single stock. The same bad year could mean losing nearly 30%. And now you need over 40% return just to get back to where you were before the drop. And in retirement, it's even worse because withdrawals can lock in part of that loss while you're waiting for the rebound. So you would need even better returns than this for your portfolio to fully recover. So the first asset you need to sell is the concentrated position in one stock. And I'm not saying you need to sell everything. The key is reducing risk to a level that you can still sleep with. So how much do you sell? It comes down to answering one question. If this stock dropped by 40% tomorrow, would it change my retirement? It doesn't matter how good the stock has been to you or how well you think you know the company. If it dropped tomorrow would change your retirement, you need to reduce your position. The second asset is one that can make you pay more for Medicare and taxes than someone spending the same amount. Here are 2 retirees. For simplicity, let's say they both spend $100,000 from their IRA each year. The only difference is retiree A receives surprise taxable income of $25,000 from an investment they didn't touch. And the reason this happens is something called the capital gains distribution. Even though you might not have sold anything, fund managers can make changes inside of the investment and pass the taxes on to you. So what's the impact? Well, this next chart shows how much extra taxable income these distributions can create in a $500,000 portfolio. Even in lower years, it can still be around $25,000 of surprise income. And this leads to retiree A being pushed over a Medicare threshold, and it costs them almost $1,000 more per year in premiums. But Medicare is just the first hit. This bottom part shows what you might pay in taxes each year from those distributions. In the worst years, it can be close to $15,000, even if you took those gains and reinvested them. And when that happens every year, it becomes a leak in your portfolio that keeps compounding. And right here, you can see the difference that can make over time. By the end of a 25-year period, the gap between no leak and a leak of 2% can be a difference of over $600,000. So the second asset to sell are the investments in your portfolio that create these same tax surprises. Whether that's mutual funds, real estate, or anything else, getting a big 1099 every year doesn't mean you're making money. It means taxes and Medicare costs are quietly chipping away at your hard-earned savings. Asset number 3 is the one that sounds like the retirement dream because it promises passive income that you can count on. But let me show you what happened to my client, who we'll call Mark, so you can avoid the same nightmare situation he faced with passive income. A few months after retiring, Mark was on the dream family trip to Italy he'd been planning for years. Him and his family were sitting down for dinner after touring the Colosseum, and his phone started buzzing. He let it go to voicemail, but it rang again. He looked down, and it was the tenant from his rental property. A pipe had burst, and water was flooding the basement. He stepped away to get it figured out, but by the time he got a contractor scheduled, dinner was over and he'd missed the moment he spent decades working towards. What retirees miss is that income always has a cost. Some costs money, and some cost the one thing you can never get back, your time and attention. So the third asset you need to sell is any passive income investment that keeps you on call. That might be a rental property, a side business, or anything that depends on you being available. And the question to ask yourself is this: if you were unreachable for the next 60 days, would this income still show up on schedule? If not, you didn't buy an asset, you bought a job. The fourth asset is one that can quietly drain your retirement even without ever going down a single dollar. No matter where you look, every article is filled with headlines like this one. Economist predicts the worst market crash ever in 2026. And when you're about to retire, the response to this seems obvious. You need to protect what took decades to build. And most retirees are trying to do just that. We recently had an all-time high of over $7 trillion sitting in cash. But the question is this actually any safer? Well, this chart shows the purchasing power of cash over time. Even if your balance never drops, inflation can cut what your money buys in half over retirement. Now, I know what you're thinking. Cash isn't for returns, it's for safety, so you don't have to sell investments at a loss. And that's true, but think about cash like a fire extinguisher. You need one or two, but having 10 of them doesn't make you any safer. If you have 1 to 2 years of expenses set aside, that cash is doing its job. Anything beyond that is an extra safety. It's just a drag on your retirement. That's why the fourth asset to sell is the extra cash sitting on the sidelines. Asset number 5 is one that even if the returns are good on paper, you need to replace it before retiring. A lot of people retire with the same portfolio they've owned for years, and it may have delivered great returns, but the question is, will it still work when you start withdrawals? This chart shows 2 investors who both earn the same average return while they're still saving. Different paths, but same ending balance. But now, look at the retirement version. Same average return, same starting amount, only now withdrawals are happening. One portfolio finishes with over $1 million left. The other runs out in their 80s. And this is because in retirement, you're not just investing anymore, you're paying yourself an income. And withdrawals can turn a market drop into permanent damage if your plan isn't built for it. So the 5th asset to sell is an accumulation-only portfolio, the set it and forget it mix that worked while you were saving but doesn't have a paycheck plan for retirement. And here's the test that needs to pass. If you had 2 down years in a row, could you still retire on time and keep paying yourself without panicking? If not, it's time to replace the working years portfolio with one that's built for withdrawals. And the 6th asset is when the retirees get pitched right when they're trying to turn their savings into a retirement paycheck. And it can feel comforting until the market drops and you don't have the confidence to spend your savings. The more money you save and the closer you get to retirement, the more likely you've heard some pitch about enhanced income or market upside with protection. It sounds like the dream investment, but think about when a doctor gives you a prescription. You don't need to be a pharmacist, but you need to know what it's for, what to expect, and what might be a red flag. Retirement works the same way. If you don't understand how your investment makes money and how it can lose money, you won't have the conviction to stick with it when the market gets rough. And without conviction, you either panic sell or you stop spending because you're not sure you're safe. That's why the 6th asset to sell is any complicated fine print investment you can't explain. Here's the test. Could you explain in a few seconds what it is and how it makes money? If not, it shouldn't be the asset paying you your retirement paycheck. But even when retirees know what assets to sell, they still struggle with one thing. They feel like the market is too risky to invest in 2026. Watch this next. It'll show you the data that will help you stop worrying about investing and finally feel confident that you can enjoy retirement.